Hello, everybody. Brian here. It is 3 o'clock, Friday, July 29th. I want to show you what's been going on. A couple of big things here. Yeah, okay, so this is my server here, chat server, quantlabs.info. You can register there for free, no problem. Okay, a couple of things I wanted to note here. So I'm going to talk about this. My new ETF Megascript is now working. Also DX feed to get API access, it's $500 a month. So if you want Python and R support for DX feed, it's $500 a month for a business account. Also, regarding that data, I've run a complete suite of all my 900 plus ETFs. They work within the range and tolerances of Yahoo Finance. So I don't think I need to really switch, as long as I do it once a day and I'm not doing a lot of requests. So I'm happy about that. Now, for recap, these are all the sectors I've segregated out. I've talked about this more in my last webinar, which is now gone. So there's that. There's about 55 of these, and more to come as I got to split up some more. And then we also got the actual ones that get generated, the tear sheets. There's profit there, so I'm going to go over those. So this is now kind of like a high level intro to what this script does and how it works. So first off, let's talk about data. As I said, I think the hardest part about this whole Megascript, when you're trying to download info and pricing data on over 930 plus ETFs, you got to worry about data. I want to go paid with DX feed, but it only works specific to MotoWave, the one I got and demoed. I've just talked about if you want access for the Python and R, $500 a month, so that's a no-go. So in essence, Yahoo Finance, as I said, is the best one, as I said here in my chat server. As for data, it might be okay to stick with Yahoo Finance since the Megascript works within the API tolerance. So that's what I'm seeing for now. And we'll go from there. Probably the next logical choice is, unfortunately, ITFeed does not work really well at all on Linux, so I might have to build a dedicated Windows system that will download data and then put it on a shared drive, let's say Dropbox or something that the Linux system will have access to. Alright, so there's all that fun stuff. So let's talk about the actual tear sheet. So as I said, I'm building out two pieces of each tear sheet. So every sector will have its own text. So in my case, let's say if I pull up this one, just a standard S&P, let's see what this contains. Let me just pull up this, see if this works. Okay, so here you get the basic breakdown of all of the metrics for that particular, call it trading basket. Some people say they want to create their own index. Fine. I can do that. Here, what I can do for S&P 500 related is I can track, the more important ones to me are these, the Sharpe ratio and max drawdown. Where's my max drawdown? It's somewhere in there. So you can see here, this is over the last year, I believe. So if you have a max drawdown of more than negative 15%, which is kind of the standard, you don't really want to put that as your top choice because it's extremely volatile on the downside. So you may not want to choose that. The idea here is when it comes to ETFs or just any kind of portfolio management, asset management, is you want to focus on what I call steady eddies that have really good performance, but yet are within that 15% max drawdown tolerance. On top of when you start looking at the tear sheets, you want to start looking at the monthly returns as well, especially for the way this is built. So let me show you some potential HTML tear sheets. So let's look at, I don't know. So again, these are all the positive ones: commodity, So let's say new, those are the renewable type of commodities like wind, solar, all that. Metal, which is gold, silver, copper even, anything to do with a metal ETF. And there can be equity in there as well. Energy is like oil, gas, and anything to do with the exploration or infrastructure, piping, all that's included. And then agriculture as well. So let me just show you, let's say agriculture. Now you've seen these tear sheets before, but what matters is the performance overall. So you can see this goes back almost a year, so it's pretty close to a year, 240 days to be exact. So again, what you're looking for is a Sharpe ratio. So when you hear about the overall inflation, you can see here inflation did definitely kick in the earlier part of the year. Here, January to, let's say, peaked in March, and then it back in May sometime, and then dropped back again. So what does this say? The inflation that we see in food costs really is in the past. Okay, when you start to see it now, I think it's more manufactured at the store, at the distributor level for whatever reason. There's that. So looking at the data, that's what the data says. So here we have a Sharpe ratio of 0.68. I mean, that's not strong. Here again, you have a max drawdown of 54%. You can obviously see it somewhere in here. And you just don't want to really trade that. And again, as I said before, what really matters is this, okay? So you can see here, January, February, especially in February, that's when the inflation really kicked in, which is the performance. March still, April bounced back, and then it started to really slow down in May, and then it really dropped in June, and then it's just for the almost complete month of July, because as I said, this is now, what, the 29th? It was a slight positive return. So you can see why analyzing these monthly returns is sort of helpful. All right, so that's a typical ETF performance based on stock or anything related around agriculture. Now, let me show you another one here. So let's take a look at metal. Okay, metal. Okay, there's a couple of things here with metal. This is going to throw you off. Okay, you have a Sharpe ratio of 1.12, so it's a double of agriculture, and the max drawdown. Let me see here. Where's our max drawdown? Again, pretty in the extreme. Now, this performance may look good, especially on the 3-month chart. You can see here again, March was very high at 39% return, 15% return in April, 31% in May, and then it dropped in June, and then July was an okay month at 13%. But what matters here is again this max drawdown. Okay, so you have an average drawdown, and then you have a max drawdown, which most analysts will look at as an overall performer. But why I say this will throw you off is because you think that gold is producing. Gold is a good metric. I put up a video yesterday on this. Really what's performing, as I put everything related, gold, silver, and all metals, including miners, okay? So when it comes to stock ETFs, there can be bear stock ETFs or short stock ETFs, and long, which most people know about when it comes to the ETF space. But this will include, this performance, last I checked, and I was thrown off by this, it included shorts on gold miners as well as regular gold miners as well. So these are short performers on those short miners ETFs. So that's where the performance is coming from. So that says something about gold. So that says something about gold if they see the market rally kick in, which you're starting to see now. Okay, so part of my analysis in that text file I just put up, I have to put, what's in this, okay, and what the description of that ETF, as well as the weighting allocation, okay, just to get a better guide. I'm just showing you the tear sheets themselves. So knowing this is very good analysis to get, when things are starting to turn, and when things are starting to, turn on the downside or the upside. And this can be confirmed based upon these are ETFs. This is where a majority of, if it's portfolio money, capital, or whatever capital, mom and pop capital is going into to get these kind of performance out of these ETFs. So even if you don't want to hold ETFs, this data is really, really good. I used to use the ONDA CFDs, and I thought that was good. This is way better. This is way better because it covers everything. All right, so that is commodity metal. So I'm just going to show you more commodities here. This is okay. So remember, okay. So this is why I use Sharpe ratio. I don't use cumulative returns. They throw you off. Here, you can see our Sharpe is at 0.68. Our Sharpe here for metal is 112. So already you know you're getting double performance with the metal versus agriculture. So now I'm going to show you energy. So commodities is a great learning lesson on all these sort of things for commodities. So here we have energy. Now energy can include oil, stocks, oil itself, oil, as I said, infrastructure, oil exploration, and same with natural gas. So this performance right here may be because of natural gas. There might be some other bear or short stock ETFs that are related in the oil/energy industry. So we've got to analyze that. All right. So here, again, monthly returns is where it's at. This is very interesting. Here we get a really good monthly returns for these, and I also have to mention, this is the really critical to get these really good performance. I remove all of the negative returning ETFs. I only will then bundle in the positive returning ETFs. That's key. Okay, so if you're watching this whole video, you'll know how where the performance comes from, because I filter out all the negative. You know, those people that watch a video for 10 seconds and then move on and continue to be poor. Well, that's kind of the secret there. So right here, these are all pods, but look what happens in June. It dropped, okay, or prior to May. May up 19%, and then inflation, however, whatever, it drops 30%, okay? And then 8%, so it's building back. Now I don't know if that's natural gas that's driving that up, but most likely it is as we go into cold season. There's going to be much bigger demand now for natural gas, because look at Europe. I just got a notification from somebody that Hanover is having to cut back all its energy by turning off the lights and no hot showers in Hanover. I mean, that's how bad it is in Germany with that for gas, because they got cut off from Russia. So that's where we stand right now for energy. Now, again, when you look at the Sharpe, and here again, max drawdown of 48%, so it's pretty extreme still, and that's because of June, that big drawdown there. But the Sharpe is still not completely strong at 1, but here you can see comparatively all the different Sharpe ratios. So this can help determine where you put your capital, and it also includes looking at and analyzing the volatility of these categories. All right, so let's look at some more. So like I said earlier, I like looking at steady eddies. Now let me show you one here if we can find it. A good example of that doesn't look like it's here. Oh yeah. So now we get into overseas. So this is outside of the, obviously, US, because a lot of these ETFs are US based, and most of them are usually bought on a US based exchange. But when it comes to the steady eddies, Japan's a good one. So when you look at it, and as I said before, you want to focus on those trading baskets, indices that perform over 2. So here's 2.23. That's really strong. And look how stable that price is, that price line, compared to the S&P 500 in yellow. That's the benchmark. So when you factor in these steady eddies, you're getting a very good return. And look at the max drawdown, negative 8%. Okay, so using that kind of metric, especially if you go into more stable pricing, yes, you do get negative months, but it's stable. Okay, so these are good ETFs, whatever they are. Okay, and again, you could be thrown off from maybe the stocks in the Japanese market could be bears and shorts, and they also include leverage as well. But when you factor in the volatility or how low it is, this is a very good steady eddy. Okay, and again, you can watch this right here and see how the monthly return is, because now we're at the end of August or the end of July. As we move into August, you can start watching day by day if this performs still, how it's doing day by day, and then you can say, okay, I'm going to keep it or recalibrate it and move the capital into other better performing categories and ETFs. Continuing along, I can show you some other ones. Some interesting ones I could show you. Back to commodities, is this one, the new category. Like I said, the renewable. This was surprising. Look how strong that Sharpe ratio is, but look at the volatility, 43%. But you compare it to something like, essentially what I'm seeing is, out of all the commodities, the new sector or category is the highest, with the highest Sharpe ratio. So that's a good sign for people that are into climate change and whatnot, for performance. And then you can see here, let's just see how these perform monthly. Again, very strong July, very strong. Okay, so if you know that, as you watch it day by day, you put more money into this one, and you would never even consider it, because if you're watching the news, reading the media online, however you consume this sort of thing, no one ever talks about these type of ETFs, but they perform amazingly this month, as you can see. So you're able to watch this, and this is how you get performance, consistent performance. But here, you want to just get in here. I mean, it had a but you want to stay away from these drawdowns. And you'd see those drawdowns on the monthly view. If it's starting to show negative, then you know it's probably time to rebalance, recalibrate. Just another interesting factor in the commodity space. All right, so going back to the overseas here now. So we have Japan, Latin America, China, Africa, and Israel. So again, these are ETFs that focuses on these regions. So Japan's looking pretty good. So let me just pull up so let's see if we have them here. So we have here overseas for Japan, I just showed you. Let's take a look at Latin America. So here, forget it. You just know it's negative Sharpe ratio. I mean, don't have to go beyond that. Europe can be pretty surprising, but again, these could be the short ETFs, the bear ETFs. So again, the Sharpe ratio is at 0.77. Look at the volatility, look at the drawdown compared to what I showed you in Japan. You avoid, right? The other one, this is where it gets interesting. When you look at China and how it's been heavily impacted by the virus, and there's zero policy. So here you have max drawdown at 21%. Their Sharpe ratio is pretty good, 1.65. But where you compare that to Japan, right here. So again, and I did this comparison in one of my webinars last week, I think, or this week, I don't know. Anyways, when you look at the Sharpe ratio of Japan, 2.23, very steady, and you look at Sharpe ratio of China, 1.65, max drawdown at 21%, and then same thing with Japan, it's -8. So again, important information to know. The one thing to compare between Japan and China, again, it's the monthly returns. So you can see here we had a slight negative July. But look at this. When you look at the monthly return for China, 9%. So that's pretty interesting. Here they had a bad month, but they are improving in China. It's just that this virus is really impacting them, and it negatively affects a lot of the Chinese ETFs. Now again, I keep stressing this. This does not mean that it's China, the stock market's doing well. These could be short ETFs, the short and bear ETFs with leverage, but they're the profitable ones. So always keep that in mind, because that can throw you off. The other one that can be a surprise is Israel and Africa. So there's only one Africa, just so you know. But with Sharp, it's 1% drawdown at 20. So you know already it's not a good one to partake in. July was pretty good, but again, bad June. So this is where you got to determine where you want to go. Actually, I can automate that decision for you, which I will. I'll be using that for my own trading. Okay, so continuing along here, so we got the regions. One of the ones I really get into is, especially on YouTube, you watch all these gurus, so-called gurus like Kiyosaki, go, oh, get real estate or Grant Cardone. If you follow the data purely, I will tell you real estate's not doing well. I mean, it's doing okay. But again, this looks good right here for real estate, but look at it, it's just barely breaking even. One thing I will say about this particular basket of ETFs is look how it performs indirectly against the stock market. Okay, so when you see the stock market starting to take off a little bit in the last few days, you can see that this thing's already going negative. So the Sharp ratio is only 1.14%, max drawdown 25%, and the monthly returns are not like, it's more negative than positive. So this is just real estate. So what I'm saying is, don't listen to what these guys say, and you don't put capital into real estate, because just a good example is, look at when the pandemic hit, tenants were able to live rent-free and screw the landlords, because the landlords are the evil ones. Some of the landlords you probably have because they got extra leverage on their mortgages, but they could be in trouble as interest rates go up anyway, so leave that at. The next one that a lot of people want is crypto. So crypto, up until last week when I was watching this, was negative, but look at the Sharp ratio. It's starting to come around now, 0.73. This includes mostly Bitcoin related, a little bit of Ethereum, and also the mining companies as well. So they're all clumped together. I've not included Grayscale here, which I will, but again, when you compare it to the overall S&P 500, crypto is still somewhat, dare I say, positive, but yet again, max drawdown. Where's our max drawdown? Right here, negative 69%. That's pretty extreme on the downside. So, so right now, if you ask me, is crypto worth put money into? Not really. When you look at it, it's just bouncing around. So and a lot of that is, I hate to say it, is related around Bitcoin. So a lot of the other altcoins are the ones performing. But who knows, if I add in Grayscale, this may change. This whole tear sheet may change. And then again, when you look at the monthly returns, mostly negative, right? So not yet. Crypto could be on its way up, but it's factoring in mostly Bitcoin. So another one people probably ask about is Treasury. This one is only Treasury. Look how flat it is. If you want stability in a ETF, this is where you go. And if you get a guru telling you only Treasury is the place to go, they're very, very lazy and probably dumb, because they're not doing this type of analysis that I'm doing to show you there is way better performance. Especially so far, the ones I'm showing you is obviously Japan, and it's steady and it's stable, right? So that one, had one negative, but look at the monthly returns; they're very low. I mean, that's typical Treasury, right? Typical bond. Let's see here. Actually, I should. So you can see all the U.S. related ones, but before I continue, what I want to talk about here, because this is a fairly new script that I've developed. In here, I've got a batch section, so there's lots of market sectors that are not, or categories that are not very well behaved, that crashed the script. So I've identified them here, which is the utilities, tech, material, and defense. I have to look in why that's not, why that is. I don't know, but I'll just say these are the bad sectors for now, but I'm hoping to get those working. Everything else works. So again, coming back to the US, you can see all the different breakdown on the tear sheets that are generated. Tech, SPAC, S&P related, small cap, short, semiconductor, Nasdaq, health, financial, energy, Dow Jones, and as I said, crypto. So those are the profitable ones. I'm sure there's some other ones in here that could be financial. Right here, financial's not doing too good, which I could probably show you right now. So for financial, again, a lot of these could include the short and bear ETFs, but looking good there, 2.3. Okay, but again, you have to, if you're going to play in these type of ETFs, you really got to watch these. When the markets improve and they do include the short and bear, they'll quickly turn on you. Okay, so not bad. Now, from my perspective, would I play those type of ETFs? My answer is probably no. Because why would you do that when you can find certain profitable ETFs that don't have a bear or a short in them? But again, it's early days in this, so I may look into that. But so far, I mean, 2.34 is pretty good compared to Japan. Yeah, but the top two so far are those. And I'd be really interested in those ETFs to put capital in for those that have the categories where their Sharpe is over 2. So finance is good. Is that financial currency I just loaded up? Okay, so that's financial currency. That's a good one because of, you know, emerging debt in a lot of the currencies. Japan's a good one as an example. So let's check out financial. Financial, I can't remember what they contain, but probably banks and whatnot as well. Not too good. Well, their max drawdown is still tolerable within the 15%, 10.53. Let's see, monthly returns again, not that strong, but it's okay. But you want to focus only on those ETFs that give you, or those categories that give you a Sharpe of over 2. That's a for sure thing. Now, in terms of Sharpes that I've looked at, the highest I've seen is 4. There are the occasional currency or cross FX trading baskets I've generated over the last few months that generate over 3. Those are good. And the volatility is fairly low too, because those are really predictable returns. All right, so got through the financial, showing you the international or overseas. Let's go through some of the stock market. So the big one is S&P. So here's the S&P, 1.5. Max drawdown of 32%, and usually June was not a good month for these. And again, a lot of these will include the short and bear ETFs, so you can see that's probably why. But again, you rebalance those, and I mean, considering, you know, I'm seeing this pattern throughout all of the tear sheets. It's all turning. Like, we had a bad month, we hit a bottom, and now August probably will continue to be a positive month for a lot of these categories in ETF space. So there should be profit. That's a universal trend I'm seeing in the last few months between the peak of May and the drop off of May, June, and then July even. But July was more stable and bottomed out. So August may be a good month. So S&P is not an exciting space. Again, they can include those bear and shorts, but you know, decent month for May. Not a very strong month for July, despite what you hear. That's if you took out only the profitable ETFs. All right, so let's check out, let's say, Nasdaq. Okay. So Nasdaq, again, it still outperforms the generic S&P 500, but the Sharpe ratio is not very strong, 0.93. This helps you determine which is the better U.S. index to be part of. Is it Nasdaq? Is it S&P? So on. So again, max drawdown, pretty extreme, negative 33. Here we have the monthly returns here, very weak. You can just look at the chart, the colors, they say it all for the last 3-4 months compared to other ETFs I've shown. So U.S. equity has definitely not been a good month for the last 3-4 months. But as I said, with a short, there are a couple of profitable short ETFs. But you can see here, it's been fairly flat again. Sharpe ratio 1.54, max drawdown of 40%. So again, the question is, do you really want to partake in those type of ETFs that have a short with leverage or bear with leverage? I just think it's kind of high risk. So you want to kind of maybe avoid those. That's what I'm thinking. Again, early days, really bad July, because you know why? Because obviously the S&P, the whole overall U.S. market has improved, so those shorts get killed, as we see. All right, let's take a look at a couple other ones here for the U.S. markets. Tech, as I said, can be hard to generate, but tech is a big one. It's something like 40 ETFs. So again, I have to split that up and segregate it out. You can see here, just again, 0.4 Sharpe, max drawdown of 30%, and then here the monthly returns, pretty bad July again. So here, in terms of splitting up this tech, there's a lot of online cyber, robotics, and other types of technical ETFs that I can separate into their own. Like as an example, I've already started that process here, where I have a category for cloud, which is cloud and cybersecurity. So I've already started seeing that, and that's probably why the data breaks on those categories. Yeah, tech is kind of not, it may turn around, I don't know, but in the past it's not doing too good. Also, this is an interesting one, SPACs. I'm sure we heard about them. This is done fairly decent, 1.4. Drawdown's not so bad compared to the other ones, 26%, but still. The monthly returns, June was really strong. So again, when you look at June, where a lot of them were negative, this one was doing really good. So again, if you were playing in the world of SPACs for June, you would have done amazingly, up 46%. So again, when I show you the crypto, you're not getting these kind of returns right now. And that's why I'm seeing now crypto should be treated as a lower priority in terms of potential return. Like the crypto space, the crypto category has to compete against these other categories for attention, for capital, right? So continuing along, here's some small cap ones. I guess this would be, I do have a Russell set of ETFs, but they're not profitable here, and this is why. You can see it's barely profitable, it's majority negative, so again, why look at it. Let me just say this though. This is a typical financial advisor book of excuses for your portfolio. Well, the losses aren't as big as S&P 500, so we're doing our job. We're amazing because our losses aren't as big. When you factor in what I'm showing you, yeah, you could be making money where you don't really need your financial advisor. To me, it's a joke, and I have reasons for it, because they're not paying attention to your individual portfolio. They have too many customers, and let's get real. They're interested in getting more customers. That's where their attention goes. And the thing is, yeah, they want to collect those fees. So, in the long run, I think if you're not doing this professionally, your potential portfolio long term is being held back. You might be happy with a 5, 10, 20% return, but here I don't know what the upper long term potential is using this type of analysis. But this to me makes more sense. I'll just leave it at that. So let's take a look at a couple more. Tech, Nasdaq. Oh yeah, so you'd think that like health would be doing really well, like medical. Look how bad it's doing. 0.29. Like this is going to include supposedly the vaccine, the big pharma, and look how bad it is. I will give it this. The volatility is fairly low, but the performance here again on the monthly returns, not that great. Not that great. But that's part of the overall mention of the overall U.S. markets have not been performing, but they may start to be actually turning now currently. Another one is Semiconductor. Let's check out Semiconductor. So again, very weak, 0.8. Forget it. Not going to look at it. These are just the profitable ones. This is the first time I'm actually seeing these. Small cap, did I look at those? Yeah, I believe so. Health. So here we have U.S. specific for U.S. energy, financial, Dow Jones as well. So let me just pull those up. I'm sure these are not. This is probably the banks. Surprise, surprise. But these may be short bear and bear ETFs, but still, the Sharp is not that great. Max drawdown -36%. So moving on. These are definitely not top performers. U.S. energy, I'm sure that's going to be very weak thanks to who. Sharp is a little better. It's not bad, 1.08, but still a max drawdown I do not like. But here's the interesting thing: it's starting to spike. July's not bad. We've seen negative monthly returns, so that's okay. But look at the prior month, or the prior month of that, very volatile. You could do well if you watch that really tightly. But again, that tells me there must be U.S. bear and short ETFs in there. Dow Jones, very weak again at 0.35. This one's not so bad, the max drawdown. So that's that. I think that's pretty well all of them. But these will come and go based upon what's driving profit, and I'm pretty happy with this. So what I'm going to do is I'm going to point you to actually, you know what, I'm going to have just go to the description if you're interested in the video, and then that will get you opted in to my email list, because I'll be pumping this out. Another big thing is I have looked at different ways to contribute on the bigger sites with the millions of people and get pretty well compensated for it is seeking alpha. So I'm looking at that as well. So as it stands right now, this is the new mega ETF script, 55 categories to work from, and that's going to grow, 934 ETFs. Now the last thing I want to say is the Forex, what I will have to do manually with the cross FX stuff. That's a lot of work. There's a lot of Forex pairs in there. If I'm able to get similar performance with these ETFs, like Japan and the other one, which was, I can't remember the other one that gave me a +2 Sharp. If I'm able to do that consistently with ETFs, is there any point in continuing doing the Forex? Because I like this process. There's a lot, I mean, I haven't even gone into a lot of the detail here. I mean, to me it's kind of meaningless, because the three metrics I use should be good enough. You can see here the monthly drawdowns. I mean, these tear sheet generation is quite good, and this is real market data. So do not, and I think I mentioned this before, if you are watching and trading based off of what some so-called expert guru says online, be it on a website or on YouTube, man, you're going to lose a lot of money. Okay, there's better ways to do it. This is pure data. This is raw data. summarizing it, categorizing it into sectors or categories, and then drawing how's the performance in the Sharpe ratio versus the max drawdown or for volatility, and overall how's the performance over the last couple of months. Because where these things are at and what they did 6 months ago or a year ago is really irrelevant. And again, I'd opt in to find out more about this. Now, as I think about this, I have here a page at quantlabs.net/academy. This one right here. So this will be part of my quant analytics. This is where eventually all this data is going to go. More community. I'm going to basically make a lot of references to my private chat server, because I own that. I don't have to worry about snooping and surveillance like on Telegram or any of the other platforms. So that's why I'm pushing that. There is a way you can download a Android mobile version. That doesn't work on Apple technology, on Mac OS or iOS. I don't make the rules on that, so there's that. And yeah, and this link right here, at this rate, with what I'm showing, and then if I'm going to start live trading all of this. I've been ready to go now for a week, and everything's been held back based upon building this. So I'm getting there with the statistics I still have to build out. So here's the thing. I've been doing this for a long time, 10 plus years, let's say. When people join, a lot of them will drop off because they don't have the time. With this type of service, what it really comes down to is when I talk to people randomly now, they don't want crypto. When I talk to people randomly about Forex, they're not interested. But when I talk to them about ETFs, they light up and they know which ETFs to go into or what they think they go into. And the thing is, they go, well, you know, SPY and QQQ, they're no good. And there's over 900 ETFs here. And and one big learning lesson over the last few weeks I can tell you is if you're putting money into basically providers, ETF providers like Bloomberg, iShares, Vanguard, I'm not seeing them pop up in the profitable ETFs. The providers I'm seeing are Invesco, Direction, DIREXION, as well as ProShares. Those are the providers I'm seeing that are profitable majority of the time. There might be an occasional boutique one. So that's one there. I mean, knowing that in itself should help people know it's profitable. So this type of service is going to go up, and it's very valuable. And more importantly, I'm planning with the kind of performance I'm hoping to get with my Interactive Brokers account. I am going to get that journal like I did with my crypto on a service called Trade Metria. Just pull that up here. Trade Metria. Okay, I've done my analysis, my research here. Now, this is going to set a new standard when it comes to people needing to proclaim their trading performance. If they don't have a third-party verified service like this, they're useless, and move on to find somebody who does that. And the thing is, not very many people do have that. So here, they have multiple brokers. Okay, so they do include Interactive Brokers, and I'm using Interactive Brokers because they have the widest selection of ETFs that I know of. On top of, the fees are supposedly the lowest that you can get on any broker. Okay, so what I pay to verify this is $30, $40 a month, and I can publish this as well. Okay, so I can put that out there and share it out. So there's some useful information there. Now, one of the other things I like about Trade Metria is, let's see, yeah, right here, the brokers. Okay, look at this. This is important. Okay, all these brokers I wouldn't touch with a 10-foot pole. Okay, so this is now what we're talking auto sync, which I had with the cointracking.info, with the following brokers. So this is near real time. Within an hour, of your trades. So for me, we're talking Kraken. Okay, that's who I trade on crypto and only trust. Everything else I don't trust. Interactive Brokers is the other one you can do real time. So hopefully I'll be able to do that with what I'm about to do with ETFs. So if you got a provider not showing this sort of thing, they're garbage. They're losers and garbage and have losing accounts. That's all I can tell you for now. So that's the direction we're going to go. Anyways, so we'll leave it at that. Again, if you come here to this URL, quant-analytics, that's where you go. Okay, so we're getting close to this, and I will be bumping this up, because when you look at it, the one I'm looking at as a metric is MarketSmith. That's 127 a month. Okay, and that's just giving you access to the research. Okay, but that's not going to give you what I'm providing you, where they factor in your live trading. Okay, and peeling back what's being traded and the weightings and so on and so forth, and have it verified. Okay, so you can imagine with all that in place, with especially with third-party verification, I do believe this service will be very valuable to financial services, namely hedge funds, banks, and so on. Especially because it's going to be verified, and if I really want to go fancy pants, I could get it audited by something like KPMG. Okay, and then I'm set gold. So what I'm saying is, there is a huge market in the financial field that I could focus on and charge a lot of money for, and there's a lot of hedge funds, financial services, capital firms that will gladly pay for that, and very high monthly fees for that. I mean, look at Bloomberg; they're $5,000 a month per seat. So that's eventually my end market. But for retail, that's what I'm focused on right now. Very affordable. If you don't do it now, then what can I say? You're going to be missing out, because this is permanently grandfathered in. All right. So we'll leave it at that. Thanks for watching. Have a good day.